afternoon, I'm Brigid Taylor and this is Currency Wars. Today I'm joined by Jan Sluis Cremer from RMB, but first we're going to have a look and see what's been happening in the markets. There is a lot to digest in a world of political uncertainty. The post-Brexit biggest risk to stability in the UK economy is the current freeze on the withdrawals from property funds. Some $19 billion is under threat and, if not contained, could well result in a severe property devaluation in the UK. However, in Europe, the German economy produced poor output data in May, and the Italian banking crisis and subsequent horn-locking between the Italian government and the ECB raises flags concerning the possibility of a second euro exit. On a positive note, gold continues to rally and the oil has strengthened as US stockpiles are expected to have declined. This assists commodity-based currencies like the rand. Meanwhile, the US FOMC minutes last night confirmed that the Fed is concerned about raising their interest rates, and their concerns raised in the previous meeting relate to the fallout post the Brexit decision. The subsequent results suggest that the Fed is unlikely to move on rates before December. This Friday's non-farm payroll data will be key this week, post a very poor print seen previously. The rand has remained range-bound post the initial knee-jerk reaction to the Brexit and is largely swayed by global sentiment. The low global rate environment and rising gold prices should be rand positive in the short term. Now that you know where we stand, I'd like to welcome Jan. Welcome today. We've got lots to talk about, so we're going to have to squeeze it into the next few minutes. Let's first just focus on, I'm really concerned about this situation in the UK. I mean, the Brexit issue, you know, it's still up in arms as to whether it was a good decision, bad decision, what the fallout's going to be with regards to trade, etc. But the really big issue now is this withholding of those withdrawals out of the property funds, because effectively that means that if they need to withdraw those funds, they have to sell property in the UK, and most of that will be in London. What do you think the fallout is, and do you think we'll see some intervention to support those?
Yeah, look, I mean, that certainly came as a bit of a surprise, the freezing of those property funds. And, I mean, we've been saying it for a while. London property market perhaps is a bit of a bubble waiting to burst. It's been rallying at 15–20% year on year now for a number of years. I mean, it's almost non-sustainable. So, yeah, definitely you will see property prices in London fall out of bed. But I do think, you know, it's that the UK still remains a good asset, and I think it just gives those people opportunities that are good. Well, put it this way, it gives other people opportunities to start looking at buying levels again, because there's only so much property. London, whether it's in or out of the Eurozone, will still be a big attraction and a global focal point for a lot of people. So,
well, I mean, you and I both know if you travel to the Eurozone and you travel to the UK and you want to see banks and you want to see financial institutions, your best bet is London, because everybody's there. When you've got to travel to Europe, it's less of a hit and miss. I mean, you've got different centres, different banks that are housed in those different centres, whereas when you go to London, you're hitting everybody. That's number one. And secondly, the Eurozone Brexit issue is going to be about trade, but that's going to be a longer-term 2-year plan, Jan. So in the short term, this withholding of that property fund is where the issue lies. Do you think there's a likelihood that somebody steps up to support those? Because ultimately it is in everybody's interest within that UK economy to support the property. As much as we think it's a bubble, the reality is that there is scarce amounts of land, and it's valuable land.
Yeah, 100%. You know, I mean, Gordon Carney, I think, said day before yesterday, he's the Bank of England governor. You know, he made kind of the same speech that the ECB governor has been saying, or the ECB president has been saying for a while now, that, you know, they'll take, you know, any steps to stop a complete meltdown of the financial system. So, you know, I think time will tell to see whether they're actually going to stand up to these property funds. I mean, yeah, it will have dire short-term consequences for a lot of people, especially those that have bought property in London at probably the top end of the market now. And, you know, and we saw it back in 2008 when kind of it was more a financial crisis, but people in the UK have this tendency to, when when something negative comes around, you know, they just want to dump every bit of property and, you know, sell it because you're going to go and get better elsewhere. Yeah. And as I said, it just provides those that are standing in line waiting, who perhaps a couple of months ago said it was too expensive. Now they've got a 15% pickup in the currency already, and plus the possibility that the property price is going to be cheaper. So, I mean, you know, how far can it really fall? I don't think it's, you know, complete doom and gloom.
Yeah, I agree with you. I have to agree. I think that it's going to be interesting to see what they do with regarding these funds, though, because that smacks of that subprime crisis, which never goes down well, especially for any of us that lived through 2008, 2009. But let's look at the Eurozone. And the interesting thing there for me is this lock of heads between the ECB and the Italians. So the Italians are stepping up and saying, we're going to support our own banks. We want to fund them and we want to control this. The ECB are saying we wanted to go through the central ECB system. Now, that's an interesting one because that potentially could result in some form of referendum that then results in the Italians potentially thinking of exiting. Do you think that's a risk in the medium term? Yeah,
look, I think, you know, that whole Brexit to vote out of the EU has potentially opened a big can of worms. So even taking Italy aside, you've already seen some of the right-wing parties in Holland and in Belgium going, well, now we want a referendum and we also want out of the Eurozone. And I think, you know, Italy is probably, out of all those nations, the ones that probably would go ahead and force a possible referendum and to move out, because it's now, you know, they've seen what's happening to England, and a lot of those fringe countries in the European Union aren't particularly happy with life in, you know, and being governed by Brussels
and Germany
and Germany.
Yeah.
And what we're starting to see is Europe and probably the developed world is starting to head kind of towards the right wing. And, you know, as soon as they get that, you know, they're anti-immigration, and we've seen what's happened across Europe with immigration in the last year or so. All the refugees coming in from the Middle East, from North Africa. And I think, you know, guys are now just kind of saying, hold on a sec, this is actually our country. We don't want to be governed by somebody. And we've got slow growth, so why should we be managing all of these people's expectations? Let's move on to interest rates. I quickly need to cover all of these things. So the other thing that we can consider now is we've got very low interest rates in the US. FOMC minutes suggesting that we're possibly going to be pushing out to December based on all the global issues. Very slow growth out of the UK and the Eurozone based on this Brexit uncertainty and obviously what's happening with the replacement of Cameron. And then we've got lower interest rates happening in Japan, and that's as a result of the safe haven buying. We're looking at if we look at Australia, they're on low interest rates. We look at the New Zealand dollar strengthening today on the back of the interest rates being kept on hold. South Africa looks like an opportunity, Jan, and let's just talk about that from an investor perspective. We're part of the WIGBY, so we've got liquid bonds, we've got entrenched currency, we've got good liquidity in our currency and our bond market, and we're offering 8%. What do you think, that coupled with the gold price in the short term, how do you feel about that as a short-term play? Definitely a short-term play. In fact, I think over the next probably 6 months, even longer, I think emerging markets are going to come certainly back into the fore again. Now, as you said, zero interest rates in the US. I doubt that they'll even look at the end of the year unless we have some miraculous recovery in non-farms tomorrow, and, you know, inflation starts running away in the US. I can't see that happening. Interest rates are staying low there. Again, coming back to Gordon Coney, the BOE governor, he's threatening to cut rates. And, I mean, as we know, UK interest rates are almost flat. So you'll probably find, like the Eurozone, they're either going to go to zero or even into negative territory. Japan's low. New Zealand this morning said, well, you know, they kept the rates on hold, but they're not too comfortable about cutting their rates, but they've left them low. Australia's low. So where does money go? It has to go into a high-yielding asset, because pension funds have got returns and they've got to look after all their investors, and they can't sit in a negative interest rate environment being charged to have your money in the bank account as what's currently happening. So certainly South Africa is a great investment. You got even a weak currency now at 1460. That's great. You know, and you're getting 8% pickup on the government bonds. And we saw it before. I mean, I remember when the WIGBY was issued, you saw guys coming in at R9.50 on the rand.
That rand went right down to R6.50. So now when you're buying dollars or pounds again, you're getting the pickup of the currency as well as that interest rate return. So that's a great double whammy for people looking to invest in a highly liquid market.
100%. If you just, and we were talking about it off air, if you just look at sterling rand in the last 6 months, if you'd managed to, if you're a fund and decided you were going to go long EM at towards the beginning of the year, and you managed to get sterling rand out at the 22, 23 levels, you've almost got a 20% return just currently on the currency. Never mind the 8% pickup that you've got from carrying the local bonds. I mean, it's been a great one for emerging markets and for South Africa. The problem we got to bear in mind is, like the equity board and the bonds, it's easy money, easy come, easy go.
Sure, Jan, but I mean, the thing is, we're going to go on to plan of attack now, but the big thing is, I think, if we look at what's happening in the UK politically, the Eurozone politically, the US from a growth perspective, South Africa doesn't look like a bad player. I mean, at least we know the devil we're dealing with. So at least for that perspective, I think sentiment speaks to a potentially stronger situation, but I'm going to put you on the block and let you give us your views for the week ahead. Stick with us. Okay, Yanni, give us your view. Pound rand, definitely, and if you don't mind, the dollar rand.
Sure. Well, let's start with pound rand. Look, we have come a hell of a long way post Brexit. I think around just before breakfast, we were around the 22 level. We broke below the psychological 19 briefly this morning. Can it continue going down? You know, pundits are all talking sterling dollar down to the 125 levels. So I'd like to think probably sterling rand's going to be a little bit limited. We need a bit of a correction and a pullback. We've come, you know, 12% in 2 weeks. I mean, that's a big move.
But it has been a big decision.
But it has been a massively big decision. So I kind of think sterling rand bottoming out around about the 1875, not just short term for now, because we've come a long way. We need to have that little correction, possibly back up to the 19.5 levels. I know ranges are going to be wide, but it's, you know, emerging markets, and it's very difficult to call a tight range at the moment. So 19.5 on the top side, 1875 on the downside, possible little overshoot, but certainly we need some consolidation and perhaps a little bit of a correction in sterling rand.
And the dollar rand?
Dollar rand, I kind of think we're going to be toppish. 14.90 now looks like a very tough level to get through. And as long as the uncertainty remains in the rest of the world, especially around Brexit, what's happening in the EU now, look for a stronger rand in the coming weeks. We've got gold rand even at 1460, sitting at almost 20,000 rand an ounce levels. So for gold miners, it's looking good. For commodity play, you know, we're looking a lot better. So I think we can possibly see if we can get a daily close through the 1465 level. We're back onto pre-Brexit levels of calling for that 1425 levels, and let's not get ahead of ourselves, but even 1380.
Sure. Thank you so much, Jan. Really appreciate it. So, thanks to Jan. And the view for the week, we are looking for much stronger levels on the rand. Obviously, keeping big eyes on what's happening with non-farm payrolls on Friday, watching what's happening in the UK and their property crisis. But ultimately, South Africa is a good investment, and we're possibly going to see our bonds rally as well as our currency. On the crosses, look for further strength on the pound, but relatively range-bound after the big move that we've seen. And if you'd like to send any of your questions or comments, you are welcome to do so at Currency Wars 410 or to myself at K1 Capital for your personal response to the FX markets. Until next week, good luck in the trenches.